Welcome back to Prosperous 17. Today we will be discussing one of the most important aspects of trading: risk management. Effective Forex risk management allows currency traders to minimize losses that occur as a result of exchange rate fluctuations. Consequently, having a proper Forex risk management plan in place can make for safer, more controlled and less stressful currency trading. In this piece, we cover the fundamentals of FX risk management and how best to incorporate them into your process. What is Forex risk management? Forex risk management comprises individual actions that allow traders to protect against the downside of a trade. More risk means higher chance of sizable returns, but also a greater chance of significant losses. Therefore, being able to manage the levels of risk to minimize loss, while maximizing gains, is a key skill for any trader to have. How does a trader do this? Risk management can include establishing the correct position size, setting stop losses, and controlling emotions when entering and exiting positions. Implemented well, these measures can prove to be the difference between profitable trading and losing it all. Top 5 Fundamentals of Forex Risk Management. 1. Appetite for risk. Working out your appetite for risk is central to proper Forex risk management. Traders should ask, how much am I willing to lose in a single trade? This is particularly important for the most volatile currency pairs, such as certain emerging market currencies. Also, liquidity in Forex trading is a factor that affects risk management, as less liquid currency pairs may mean it is harder to enter and exit positions at the price you want. If you don't know how much you are comfortable with losing, your position size may end up too high, resulting in losses that may affect your ability to take on the next trade, or worse. Let's say 50% of your trades are winners. In the long term, mathematically you can expect to have runs of multiple losing trades in a row. Over a trading career of 10,000 trades, the odds suggest that you will face 13 sequential losses at some point. This underlines the importance of knowing your appetite for risk, as you need to be prepared, with sufficient money on your account, for when bad runs hit. So how much should you risk? A good rule of thumb is to only risk between 1 and 3% of your account balance per trade. So, for example, if you have an account of $100,000, your risk amount would be $1,000 to $3,000. 2. Position size. Selecting the right position size, or the number of lots you take on a trade, is important, as the right size will both protect your account and maximize opportunities. To select your position size, you need to work out your stop placement, determine your risk percentage and evaluate your pip cost and lot size. For more on how to do these things, click on the link above. 3. Stop losses. Using stop loss orders, which are placed to close a trade when a specific price is reached, is another key concept to understand for effective risk management in Forex trading. Knowing the point in advance at which you want to exit a position means you can prevent potentially significant losses. But where is this point? Broadly, it's whatever point your initial trading idea is invalidated. How to use a stop-loss order for managing trading risk. Traders should use stops and also limits to enforce a risk/reward ratio of 1:1 or higher. For 1:1, this means you are risking $1 to potentially make $1. Place a stop and a limit on each trade, ensuring that the limit is at least as far away from current market price as your stop. 4. Leverage. While researching how traders fared based on the amount of trading capital being used, Daily FX senior strategist Jeremy Wagner found that traders with smaller balances in their accounts, in general, carried much higher leverage than traders with larger balances. However, the traders using less leverage saw far better results than the smaller balance traders using levels over 20:1. Larger balance traders, using average leverage of 5:1, were profitable over 80% more often than smaller balance traders, using average leverage of 26:1. 5. Controlling your emotions. It's important to be able to manage the emotions of trading when risking your money in any financial market. Letting excitement, greed, fear or boredom affect your decisions may expose you to undue risk. To help you take your emotions out of the equation and trade objectively, maintaining a Forex trading journal or log can help you refine your strategies based on prior data, and not on your feelings. This is a fundamental area that most new traders neglect, and in the coming videos we examine how best to implement it into our trading plan. Until then, all here are prosperous 17 wish you a very successful week ahead.